Many of you, if you might have $1,000 in your pocket one day and decide you want to do something other than put it under the mattress. Do not just go and buy one stock. Do not say, I really think Carnival Cruise is going to have a great year this year, or Delta Airlines, and put it all in one stock. Give it to somebody professional, and they will do something called diversify, which means they will take the money and they will put it all over the place. Different equities, right? Different businesses that are in different lines of business, like energy, for example, like communications, technology, industry, etc. So that's good, and they'll put it in things like municipal bonds and debt too. They'll diversify, right? So that the risk is relatively low and there's still some reward involved. So when you do this, you end up investing in companies that sometimes can have really outrageous carbon footprints. And there's been an effort to divest from companies that are in the business of producing fossil fuels. And when that does happen, other investors who don't have those same priorities end up investing in those stocks. And there are also companies that have in their supply chains a lot of carbon and don't make excellent efforts to address that carbon footprint. So it really is time, and fortunately, we have the right man to talk about it. It is time to think differently about what socially responsible investing is and what investing means. What it means to invest in such a way to reduce the carbon footprint? What real actions can you take to actually reduce the carbon footprint of what you're investing in as a responsible investor? Seann comes to us from Hampshire College in Western Massachusetts, where they probably make you write a lot, but they do not give you grades, but they give you very thorough evaluations. And Seann went on from Hampshire College to work in the financial services industry in business development and all sorts of stuff like that for about 3 or 4 years. And he's doing this capstone really at the intersection of finance and climate, which has been personally really fascinating for me to advise this capstone. So with that, I have the pleasure of introducing Mr. Seann Stoner. The floor is yours, sir.
Great. Thank you very much, Corey, for that fabulous introduction. Just going to share my screen here. Yeah, so the title of this presentation, An Alternative to Divestment for Climate Change Impact Investing. Start off here with just kind of giving a brief outline. As Corey mentioned, there's something called divestment, which I'm sure many in attendance are at least minimally aware of, but really it's the act of divesting or selling, getting out of certain lines of business that you disagree with for a variety of reasons, be it moral or risk or what have you. And then I'm going to be going into the Intelligent approach, which Intelligent is a company that I was part of starting back in 2015 after graduating from Hampshire College, which is a climate risk analytics platform. It's now working with the likes of the United Nations Joint Staff Pension Fund, Societe Generale, among other kind of a wide selection of institutional investors developing climate smart products. And just kind of be talking about how our approach is a little bit different than kind of the traditional paradigm around divestment. And then I'll be getting into kind of the new methodology for evaluating impact, which I developed in tandem and on behalf of Intelligent for my capstone. But finance is, there's a lot of complexity behind it, a lot of jargon. Some people, think, if you work in finance, you're the devil. Some people go to sleep if you start talking about finance. So really, the one takeaway that I hope the audience in attendance today has is that divestment, while it may seem like a great idea, it's simple, it's clear. There are the people you don't like, don't give them your money. But in terms of climate change, there's no real silver bullet here. It's climate change is complex and it can't be fixed with a simple fix. And thus you need a solution that rewards companies, even oil and gas companies, traditional energy companies, that are addressing climate change within their business operations. And really that this approach could lead to lowering emissions and lowering the impact that we have on our planet through commercial activities. Generally though, when you say you work in finance, people have certain ideas about that and think that, when I tell them that this is my office, working in the Death Star, or, that this is my boss, Darth Vader. But there's actually a very long history of investors seeking to have some kind of social benefit as well as make money. And this goes back actually hundreds of years. But in kind of has taken more of a mainstream approach since the 70s and kind of the movement against apartheid government in South Africa, as well as the environmental movement that took place with Earth Day and some of those moments that have really been defining in terms of the environmental movement in the United States and globally. But really the question gets down to, how do you align your investments with your beliefs? And so as again, Corey mentioned, and I said in my kind of the outline, this approach has been divestment. And divestment is really the act of removing companies that you disagree with. And this has really picked up support, as I said, in the last couple of years, last couple of decades. And particularly around climate change, this has grown. And since, or as of September 2019, $11 trillion has been committed to being divested from fossil fuels. And that's a very large number, as well as when you think about the total assets under management globally is over $80 trillion. So that's a fair percentage. But you have to think about this a little bit deeper. You have to ask questions, are people actually following through with these commitments? How are they meeting these commitments? You really need to ask those questions. And one of the groups that have done this is, our own University of California system. They've committed to being fully divested from fossil fuels, and it's one of the largest schools in the U.S. to do this. Again, you really need to ask and look deeply at whether they've done this and how they're engaging and whether it's having impact. So, as I said, look past the surface and ask questions such as, by divesting, have you actually decreased the amount of emissions that's in the supply chain in which you're engaging with? Are the companies that you've divested from, pulled your money, even for somebody like UC Regents, with billions and billions and billions of dollars that are pulling out of these companies, are those companies doing anything differently? Other investors down in there, the act of divestment is actually taking your asset and you're selling it to somebody. To divest, you must sell it. So are other investors, are their behaviors really changing through your act of divestment, even for large investors? Also on the other end, the consumers, have their behaviors changed as a result of your actions of divestment? In terms of climate change, which is extremely complex, as you all are well aware, and it's connected to the heart of economic activity, which is the consumption of energy and thus the production of greenhouse gases. Does divestment actually address climate change? Are emissions lowered? And so this is what Intelligent really kind of, some of these questions is what Intelligent started to ask in 2015. And you may recognize some of these faces. They've been really instrumental in co-founding Intelligent, and the climate scientists have really come in and said, how can we take climate models and the climate knowledge and think about ways to approach climate change? And what we kind of have come to over the past couple of years of really researching and developing an approach is, rather than divesting, try to identify companies which are preparing for the realities of climate change. And this is something called transition risk, and within financial parlance. And that's the idea that climate change, whether it's through policy changes or through changes in energy prices or changes in technology, there's going to be massive transformations that occur within the economy. And so you have to find the companies that are preparing for those moments. And how you do this is you select the leaders from the laggards on a sector by sector approach. So you don't say, oh, one sector is particularly bad versus the other. You say, let's find the leaders, let's find the laggards, and let's score them. And we do that by using the same models used by the IPCC. And we've developed something called the Smart Climate E-Score. And really, at the heart of it, it gets down to the question of, in the face of climate change, who's going to do better? ExxonMobil or British Petroleum? Microsoft or Apple? And we go across a wide range of companies, and we do that and then build portfolios based on that information. And what was interesting is that when we did that and then we tested it with our clients, first client, as I mentioned, was United Nations Joint Staff Pension Fund. And then the second major client was the Société Générale, big French bank. We found that actually these portfolios did better. They outperformed their benchmark at which you compare your performance of your portfolio from just a strictly performance basis, as well as you did it with less volatility. So there's less bounce within the stock price. And that was amazing and very exciting. But then also, what about the climate impact? How do you go about measuring how climate change is shifting in these portfolios and how it's impacting that? And this is really at the heart of my capstone. And this is what I sought to look out to do, because Back in 2015, Mark Carney and Michael Bloomberg, who some of you may recognize those names, got together and started something called the Task Force on Climate-Related Financial Disclosures. Same year that Untitled was launched, and they got together and asked, how can we normalize? Companies and investors are starting to think about climate change, but how can we kind of normalize the data and normalize the processes at which we think about this so that it becomes something that everybody can do easily? And they released a set of recommendations in 2017, and within that there was a section that looked at how investors should analyze the amount of emissions within their portfolio. And they published 5 different metrics. And I looked at those metrics and identified some gaps. And that's really what the heart of this capstone is. And looked at 6 different portfolios. One, I'm going to just spend some time because this is really important on this graph and on the next slide. The first portfolio is called the All Country World Index. That's ACWI, and that's the solid blue line here. And the x-axis is time, and the y-axis is tons of CO2 per $1 million invested. So if you take $1 million, you put it in this portfolio, you own a percentage of the companies within that portfolio, and thus you own a percentage of their total emissions. And that is what is being calculated here on the y-axis for the total portfolio. And this All Country World Index represents about 40 different markets, across the world, developing and developed, across all sectors, across all 11 major sectors, financial services, healthcare, energy, all of them. And it's over 3,500 companies. And investors, this is a very highly used index. Billions of dollars goes through this every year. And it really is the metric that investors use to analyze kind of the financial health within public equities of the financial economy of the planet. And so that's the top one. And obviously, this is a sector neutral approach. So if you didn't care anything about climate change, kind of a business as usual approach, this is the portfolio you would invest in. And then draw your attention down to these bottom ones. These are so 2 groups, State Street and iShares, took the ACWI portfolio and then took the carbon footprint and identified the highest emitters on a sector by sector basis and removed those companies from the portfolio. So this is a divested portfolio, low carbon approach. And that's the solid green and solid light blue lines, low C and CRBN. Now the dashed lines are what happens when you apply the Smart Climate E-score to these portfolios. And again, as I mentioned earlier, the Smart Climate E-score is really identifying the companies which are leading in terms of how they're addressing climate change within their own operations. And as you can see, you kind of start to get the picture here that, while ACWI starts to trend down in terms of historical and as well as projected values, and same thing with the divested portfolios, they're kind of flatlined. But when you apply the Smart Climate E-score, it really changes the vector of the emissions reductions, which is very, very exciting. And I'll just go to the next slide. This is kind of for visual folks. And for people who really enjoy more on the numbers end, I'd really point your attention here to the fact that, as you can see for ACWI, it starts off with about 41 tons of CO2 per that $1 million investment. And then it drops down to 25 tons forecasted out to 2030. And that's a change of 16 tons or almost 40% reduction. But then if you apply the smart climate approach there, you have an increase. You have almost a 60% reduction, and which equates to about a 24 tons of difference there. And while that's a lower percentage, you look over to CRBN, which actually had a slight increase of projected CO2, and even the smart climate version of CRBN, which had almost a 70% reduction, but that only equates to about 6 tons of emissions reduced. And the same thing for, low C over there, almost a 50% reduction, but it only equates to about 5 tons or 6 tons. And then same thing for smart climate low C, more than 80% reduction, but that's just about 9 tons of CO2 reduced. And how I kind of approached this was I knew that I just couldn't take the carbon footprint as recommended by the TCFD. I knew that I had to look at something over time for the total performance of the fund. And I also knew that I had to project it out into the future because while past carbon emissions are important, we really care about where we're going. To meet these targets of 1.5 degrees or 2 degrees, we really have to bend that curve down. And so we need to think about it in terms of projections as well. And I also knew that you couldn't just take the tons of CO2. You had to look at it in terms of economic welfare analysis. And so what I did there was I took the difference of the amount of CO2 emissions in 2015, my first year of data, and then the projected value into 2030, and I looked at the difference. And I took that in tons of CO2 and I multiplied it against the social cost of carbon to get a social welfare economic value. And the social cost of carbon, I'm sure many of you know what that is, but it's basically the marginal cost of impacts for non-market impacts for a ton of carbon emitted today going out into the future. And there's a lot of different values, starting from a couple of dollars going up to several $1,000s. And for my analysis, I just used $50 as published by the Environmental Defense Fund. There's a lot of work, including being done at Scripps around the social cost of carbon, but I just thought for simplicity's sake, I would use that value. And here's kind of this, in summary, kind of the step-by-step approach. Step one, I took that CO2 footprint value that was recommended by the TCFD. I then took the growth rate, kind of how it changed over time. I then forecasted that out into the future, out to 2030. And then I turned it over into a social welfare economic value by using the social cost of carbon. And that was really trying to get at the impact, how you evaluate the impact of a portfolio in relationship to the emissions. And so with that, I just really want to thank the folks here at Scripps, some folks over at UC San Diego, up on Upper Campus, as well as the University of Oxford, where I spent some time with Ben Cuddlecott, my cohort there, and then everybody at Intelligent, who I just absolutely love working with, and then of course my family. Really everybody came together here to make this project what it is, and I couldn't have done it without you. So thank you very much.
Great job, Seann. All right, we've got a couple minutes for Q&A. So we've got some bravos in the comment box. And then for those of you who have joined, if you have any questions that you'd like to ask to Seann directly, go ahead and put that into the Q&A box.
Do you have a question in the box? I have a question if you don't.
Perfect. Go ahead and start us off, Corey.
All right, Seann, let's say that I wanted to start an energy business, right? And I had to just borrow a ton of money to do it. Mm-hmm. And my competitor wanted to do the same exact thing that I was doing, but it was a spinoff from another company, and they started with $750 million in the bank. And the business, it's a pretty good business, but it requires you to be a little dirty at first, right? So I'm going to produce the same exact products as the other company, but the thing is, I have to borrow at like 7 or 8%, and they have a pile of cash. So if I want to cut my carbon footprint, I don't have much flexibility. I have to do what I'm doing. And then once I get to a certain point, I might be able to be more socially responsible. Does Intelligence eScore take into account that sort of adaptability? And if it does, would the company with the weaker balance sheet to start out be viewed as less adaptive? So then the company that's been doing things okay all along might get a higher score, and this might have some negative effect on that smaller company? Or would the eScore kind of address that potential for chilling small business that really can't be that flexible early on? Small publicly listed companies, obviously, big enough to be like Russell 2000 company.
Yeah. So, I mean, what the eScore is getting at is testing a company's ability to deal with changes in energy prices, in new technologies, and in policy shifts. So, if a company, obviously, like what you're saying is has a huge amount of debt with a low amount of flexibility in terms of how they would deal with any kind of shock. I mean, whether it's COVID-19 or some kind of disaster within their supply chain, they're going to be likely scored lower. Because it's really looking to what the eScore is looking to identify are those companies who can deal with big shocks to their system, which can be expected with climate change as the economy starts to price that into how equities are being priced.
So that kind of like we've seen with the shock to the economy, Amazon's done extremely well. There's been a lot of consolidation in the oil and gas space because companies like Occidental, et cetera, have had a lot of debt problems. So we've really seen those flexible companies thrive in this time, and we've seen other companies not thrive.
Yeah.
So how do we work with that issue?
Yeah. So I mean, companies just you need to start identifying. I mean, that's what the scoring metric is designed to do, is to identify the ones that will be resilient to this and to these shocks. And it is unfortunate that with smaller companies in any situation, with COVID-19, I mean, smaller companies are taking a hit, and that will, when policies start shifting or when new technologies start being introduced, the companies that are able to be less nimble are going to take a hit. But really, the interesting part about what we've uncovered with, this analysis for this capstone is that when you do create a portfolio around those more nimble companies, your emissions are going down and your risk is going down and performance is going up.
Cool.
Yeah.
I think we have a couple more, right?
We do. So we've got about, a minute and a half, but we've got 2 questions in the Q&A box. So the first is from Pooja, who says, Seann, great presentation. What do you think is the future of this product in relation to the corporate markets and capital mobility towards emission reduction?
That's a great question, Pooja. I think so as I believe I said at the beginning, this product is now being rolled out. Like what I've done for my capstone has now been productized, and we're now out selling that into the market. And so what I would hope, as being someone who was part of starting this company, working here, my hope and belief is that this is going to be taken up by the market, because it really solves some issues that have not been addressed within current kind of carbon footprinting, climate-focused impact investing. And really, I mean, the 2 main points there is that it's a projection out to the future. So it helps institutional investors figure out whether they're on a path towards a 1.5 degree scenario, or as close to that as we possibly can get, as well as having a better performance within those portfolios. So I think I'm very optimistic in terms of this product being uptaken by the market.
Excellent. And then last question comes from Thomas. How has your time and work on this analysis impacted your view of the world's future and the possibility for a sustainable future?
I was, this may be kind of sound like a weird answer, but prior to COVID, I was feeling like I wasn't feeling super optimistic. And then COVID comes along, and the economy, the actors within the economy had to really readjust, and they had to start with like Matt's presentation about, people working from home and the environmental impact of people working from home. And to see that shift occur, and to also see this like huge, I read some article about, I think there was like a 17% reduction in emissions. I mean, and I think the CO2 observation of Mauna Loa is going down, or the emissions there are being measured as decreasing, at least for this period. It made me a lot more optimistic in terms of what the future can be, and the role also that people can play within business to forward the money where it needs to go to actually address global issues such as a pandemic or climate change.
Excellent. Thank you so much, Seann.